Is the mall ready to make a comeback? If you'd asked me that question last week, my answer would be absolutely not. But now the game has changed because yesterday we got a statement buy. I'm talking about Simon Property Group's takeover of Taubman Centers, one of the premier shopping mall owners in America, for $52.50 in cash per share. That was a 51% premium to where the stock was trading. It's a monster bid, one that's generous to a fault. Or at least it looks generous. Yet Taubman stock blew right through it at $52.50. It's now $53 and change. Perhaps because there are shareholders who want more from Simon, or perhaps there's another bidder lurking, though that does seem unlikely. I have no idea why Simon's paying such a colossal premium, but Chairman, President, and CEO David Simon is the acknowledged dean of the industry, and if he thinks it's a good price, then who am I to criticize? I think the big bid may be a recognition of just how cheap this whole group's become, and they are cheap. Even after this huge bid, Taubman sells. Well, it sports a 5% yield. Why do I call this a statement buy? Because when you listen to the conference call on the merger, you'll hear Simon talk about how he can fund the deal, as he says, quote, without ever going to third-party financing, end quote. More importantly, he's not giving away his precious equity down here. Simon continues, quote, if you look at the multiple of earnings, EBITDA, net asset value, any metric you want, we are undervalued, and I have no desire to issue stock at this time, end quote. Hey, that's a staggering indictment of the stock market's inability to correctly value Simon's stock versus its assets. I think it's weighed down by the real estate investment trust ETFs because Simon's one of the best-run players in the industry. It's paid out a staggering $33 billion in dividends in its time, but a poorly performing REIT fund will crush the good with the bad. Now, Taubman's largely a collection of the finest malls. I have one literally down the block from me. I can walk to it, the mall at Short Hills. While there's been turnover at the mall, and Neiman Marcus is made as an anchor, is probably a suspect tenant because of that ugly balance sheet, it's still a destination worth going to. They've got a fabulous set of high-end foreign specialty stores, best Apple retail outlet I've ever been to, and I think that says a lot. That said, I think these mall REITs get judged based on their weakest tenants. They have 7 that belong to once large companies that have grown too small for me to mention on the show. 3 Lord & Taylors and 4 Macy's. All these places are not so hot. But Simon says they'll have replacements for these stores that are really fantastic. That's his term. I think he's got something big up his sleeve because he was able to capture Forever 21 in bankruptcy. He really wanted it, along with Brookfield Property Proper, smart guys, and Authentic Brands. Oh, wow. Excuse me. These guys are really smart. They paid just $81 million. I thought they bought nothing. There's got to be something up their sleeves. Authentic likes brand value, so they must see something. Simon and Brookfield could stand to make a lot of money if they can lease these properties for much more than they would have gotten from Forever 21. Now, put these both together, and you can see a picture of a determined, smart real estate visionary who thinks his stock is too low, despite the perils of brick and mortar in an Amazon world. Simon has an alternative to the stores that are closing, and if he's right that he can bring in better stores, getting out of these contracts with poorly performing retailers, I think it could be a huge win. So why is this so important besides just thinking that Simon's stock is cheap? Because you know what? There's another group that's ripe for a similar kind of consolidation. It's the oil and gas stocks. The fossil fuel stocks have collapsed here. But as I pointed out recently and repeatedly, while I think they're uninvestable, I think that they can do something to help themselves. If an oil CEO who believes in the industry wants to put his money where his mouth is, it's time to stand up and make a statement buy like David Simon has done. The longer we don't get one, the more likely it is that the energy stocks deserve to be down. So will someone stand up and play Simple Simon? The clock is ticking. The bell is tolling for the entire oil and gas group. Now, is anyone listening? Stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.